Welcome to today's Explainer, everyone. I'm your senior economic analyst, and today we're diving into a top-down macro briefing. I've prepared this specifically to help our junior portfolio managers and those of you who are finance students really get a grip on the current and frankly quite turbulent economic environment. Look, we are seeing some massive tectonic shifts in the markets right now, and it's absolutely vital that we understand the underlying mechanics of what's going on.
To really understand the urgency in the markets right now, I want you to focus on this staggering number, 4.591%. That is where the 10-year Treasury yield has just jumped to. Now, this isn't just some random statistic. The 10-year note is the main benchmark for U.S. borrowing. So when it spikes like this, it creates a massive gravitational pull that affects literally every single asset class in your portfolios.
Okay, here is our roadmap for today. We'll start with the macro picture, move through geopolitical shocks, touch on the Fed leadership changes, and finally, analyze how surging bond yields and opportunity costs are impacting everything from equities to tokenized treasuries.
Section 1. The current macro environment.
Right off the bat, the core issue forcing a total reassessment of monetary policy is inflation, and it's proving stubbornly difficult to tame. What's really interesting, and a bit concerning, is the uniform acceleration of prices across the board. Just look at the data. Consumer Price Index inflation hit 3.8%, which is the highest we've seen since May 2023. Producer prices, signaling pipeline wholesale costs, are running at a 6% annual rate. That's the highest since late 2022. And import costs, up 4.2% year over year. As analysts, when we see inflation accelerating across all three of these pillars at the exact same time, it tells us that pricing pressure is deeply embedded in the system.
Section 2. Geopolitics and energy spikes.
So what exactly is driving these messy, hotter-than-expected inflation numbers? Well, we always have to look at the underlying plumbing. Right now, geopolitical frictions are acting as direct catalysts for a huge surge in global energy prices. We're watching the escalating Iran conflict and broader Middle East tensions directly drive up energy costs. In turn, importers are being forced to hike their prices just to compensate. Plus, those recent high-level meetings between President Trump and China's Xi Jinping, they yielded very little relief, which leaves the markets pretty anxious about continued friction.
This brilliantly illustrates the immediate economic impact. We're seeing both U.S. and global crude benchmarks pushed straight into highly inflationary territory. West Texas Intermediate has shot up to $104.39 a barrel, while Brent crude, our global yardstick, hit $108.30. When oil runs this hot, you have to remember that cost bleeds into absolutely every single physical good that gets transported. It just compounds all those inflation metrics we just talked about.
Section 3. The Fed leadership pivot.
Now, these external shocks lead us directly into the institutional friction currently unfolding over at the Federal Reserve. We are witnessing a monumental transition. We're going from outgoing Chair Jerome Powell's cautious hold, where rates were kept steady around 3.5%, to incoming Chair Kevin Warsh. Warsh is widely viewed as being open to faster and deeper cuts, but he's also facing immense political pressure from President Trump, who's been pushing for borrowing costs to drop all the way down to 1% to spur growth. It's basically a central banker's worst headache, trying to cut rates while inflation is still throwing a party.
But here is the critical disconnect that you need to be monitoring. Despite all the political desires for cuts, investors are rapidly pricing in an increased probability of tightening. According to the CME FedWatch tool, traders are now assigning more than a 44% probability of a rate hike by December. That is a massive reversal from earlier this year. The bond market is essentially fighting the political narrative.
Section 4. The bond yield surge. Let's look at how this pressure builds across the yield curve. The two-year note, which is incredibly sensitive to Fed policy, is sitting at 4.08%. The 10-year is at 4.59%. And wow, look at the 30-year bond, it's topping 5.12%. We have not seen levels like that in nearly 2 decades. This steep, aggressive rise is a massive warning sign that expectations of easy money are fading fast.
This quote from Peter Bukvar perfectly captures our current reality. Long-end rates are now in control of monetary policy. Inflation is still a problem. Bond markets, not just central bankers, are the ones dictating financial conditions right now. To put that into perspective, the government just spent $97 billion in April simply servicing the interest on its debt. The bond market is firmly in the driver's seat, for sure.
Section 5. Asset opportunity cost.
Okay, so what does this all mean for your portfolios? High yields completely alter the math of investing. The absolute most crucial point here is grasping the concept of opportunity cost during a rate hike cycle.
If you can get a guaranteed risk-free return of over 4 or 5% simply by lending your money to the U.S. government, well, any asset that doesn't pay you a yield suddenly looks a lot less attractive. You're literally costing yourself that 5% just by choosing to hold something else.
When you contrast these asset types, it becomes pretty clear why capital allocated to non-yielding things like Bitcoin or gold is facing massive headwinds right now. Bitcoin is currently stuck below its 200-day moving average of $80,000. Gold has fallen to $4,614. Because neither Bitcoin nor gold generates a yield, they really struggle to compete for capital when risk-free treasuries are offering such a high, safe return.
And hey, even traditional equities aren't immune to this. The S&P 500 is stumbling off its record highs as the cost of capital climbs. When borrowing costs go up, corporate profit margins get squeezed. As a result, investors start pulling their money out of stocks to lock in those safe, high-yielding government bonds.
Section 6. The Tokenized Treasury Boom.
Now, innovation never stops, even in a tight economy. Ask yourselves, if non-yielding crypto assets are suffering from this major opportunity cost, where exactly are on-chain investors hiding out? They aren't all just cashing out to fiat. They're adapted.
The answer is a record-breaking number. The on-chain market value for tokenized treasuries has surged past $15 billion. It's a phenomenal pivot. In a wonderful bit of irony, folks in the decentralized digital space are basically saying, hey, if we can't beat the high yields of traditional government bonds, let's just tokenize them and bring the whole shebang on-chain.
It's a real game changer. This proves that forward-thinking investors are successfully blending blockchain infrastructure with traditional safe haven financial plumbing. The protocols offering on-chain access to this yield-bearing debt are seeing absolute record inflows precisely because they solve the opportunity cost problem.
I want to leave you with this final, vital thought to ponder as you review your allocations for the week ahead. As long-end rates take control, will central banks actually manage to rein in the bond market? Or has the opportunity cost of digital assets been fundamentally changed for good? It's the multi-trillion-dollar question we all have to navigate. Thank you for joining today's Explainer. Stay sharp out there, and I'll catch you in the next briefing.